Good morning, everyone. Welcome to the GIS Sea Level Rise seminar. Today we have Dr. Yara Mohajerani. He is the co-founder and CEO of Envai Solutions, Inc. in Toronto, Canada. And he's also an affiliate assistant professor in the Civil and Environmental Engineering Department at the University of Washington. Dr. Mohajerani earned his PhD from the University of California, Irvine, where he utilized remote sensing data, computer vision, and machine learning to study changes in ice sheet and glacier mass balance. And after that, he was a postdoctoral fellow in the Civil and Environmental Engineering Department at the University of Washington in Seattle. He earned his undergraduate degree in physics and mathematics from the University of Toronto, and he founded his first startup company in Toronto in 2014. And his present company, Envai, focuses on bridging the gap between scientific knowledge and commercial services for addressing the world's environmental needs. And today, Dr. Mohajerani will be speaking on the topic sea level in the private sector, translating the science for business mandates. So, welcome.
All right. Thank you, Patrick. Thank you for the introduction. Happy to be here. This is going to be a bit of a different talk than what probably you're used to, given the industry connection. So let me go ahead and share my screen and we'll go from there. Okay. Do you see the presentation mode?
Yes.
Okay, fantastic. Cool. Yeah. So like I said, this is going to be a talk that explores a lot of the science that we as a community work on in academia and how it actually makes a difference in industry. So I'm going to try to navigate both worlds in this talk and show hopefully a different perspective. So yeah, bit of a different talk. Let's dive into it. Before I start, just a bit of background on my research when I was doing my postdoc in Seattle and before that at UC Irvine, just to give you some background on myself. A lot of my PhD and postdoc work focused on finding automated ways of regionally optimizing mass band processing methods for regional ice sheet estimates. So basically coming up with optimizations for individual glacier basins or water basins that maximize the signal we could get from there. And then I did a lot of work for basically using deep learning methods to determine glacier calving fronts or grounding lines in two different studies that we did. So I had this background on the machine learning side and in the grace and glaciology side, and wanted to bring that to the private sector to try to apply a lot of that to the fast moving field that's the climate space in the private sector. So in February 2021, I made the switch to start a company with one of my old friends from my physics days, and yeah, it's been a lot of good learnings, and I'm happy to comment on those during the Q&A if people have any questions. But to jump into it in terms of the sea level components, when you mention sea level in industry to a lot of researchers, they immediately think of physical risk, right? How do we model regional risks for flooding, for sea level, for extreme weather events, all that kind of stuff. And that's obviously a huge component, right? A lot of companies are putting a lot of money into understanding the risks to their own physical assets, but there is a lot more than that. And what I'm going to talk about today actually has nothing to do with the physical risk to the companies. And that's the world of climate mandates. So to zoom out a little bit, in the past maybe 5 years, there has been even more pressure on a lot of private companies to actually start to figure out their own impact on the climate. Not so much the impact of the climate on their operations, but how they themselves are contributing. this has taken the form of a lot of shareholder activities demanding them to do better. There's a lot of regulations in different countries, a lot of fines coming down. So this has given rise to the world of ESG, or environmental, social, and governance, which are basically non-financial metrics to assess a company's practices in those three spaces: environmental, social, and governance spaces. And it's increasingly becoming a core tenet of how companies are being evaluated by the financial sector, by their own customers, and of course by their own shareholders. But there's so many issues in this. So there is a lot of lack of science still. And when we started this field, or when we got into this field with Envai, my company, there was really, at best, a lot of organizations were giving ABCD rankings to how a company might, for example, affect the world's, in their own way, affect to sea level rise, biodiversity loss, temperature loss. It would just be, all that complexity would be like a simple rating, like a credit card score, A, B, C, D, nothing robust. And we wanted to bring a lot of the science that we've been working on as a community to actually make a more robust framework for evaluating these things. And to this day, because of all the greenwashing and the wishy-washy nature of a lot of what's going on, despite the increasing amounts of money being spent on climate data, or ESG data as a whole, there is all kinds of news articles coming down. So Goldman Sachs is this is from a couple of months ago, was facing a SEC probe for ESG. Deutsche Bank literally got raided by authorities for greenwashing practices. So it's becoming serious business, and it's still trying to navigate that wishy-washy space to become a more robust framework. And if you look at the annual spending and ESG, 2021, just the data that people were buying just to get the bottom line framework of what they're doing is basically exceeding $1 billion annually. So it's becoming large. Despite all that, 72% of decision makers say they actually don't have confidence in the data they're getting. This is climate data that these companies are getting, the financial decision makers, financial institutions, and 72% don't have confidence in climate data in 2023. That's something that should be changed. And this is really at its heart a science challenge, and that's what motivated us to get into this. These companies have all kinds of metrics and measures, and they put out all these reports, different kinds of emissions from their supply chains, how much energy they're using, their own burning of fossil fuels. And somehow you got to take all of that and just say, are you aligned, let's say, with the Paris Agreement in terms of a warming scenario? And it's a challenge of data in part, because these companies just are trying to figure out even what they're doing. But it's also a challenge of converting all that to a scientific understanding of their effects on the climate. So the way we wanted to approach that was to basically get all that data, all those the raw footprint that's being put out by corporations. I also apologize for the noise. I'm on a emergency business road trip, so you're in the hotel lobby right now. If at any point you can't hear me, let me know. So the idea is taking all the data that's being put out by the corporations and automatically basically standardizing all the climate data, meaning the raw fundamental emissions, the practices, everything that the companies are doing, and then start to do basically climate modeling and model the trajectory of the climate based on the data that we have on the corporations. And each of these, it's its own challenge and one of the areas that we focused on. So we basically, even though the largest challenge is actually in the data aspect, I'm just going to focus on the climate trajectories for this talk, and talk about the climate pathways, and how that feeds into sea level. This is all leading to sea level, believe me. So basically, how do we model the effect of a corporation on the climate, given its practices, given that no one corporation can have a real measurable effect by itself on the climate, right? Even if you're Exxon, you're not going to single-handedly, change drastically the world climate trajectory. So, but that's the goal. That's what we want to do, and I'll talk about how we're going to do that. We take the emissions of these companies. So just to give a little bit of the terminology, there's scope 1, 2, and 3 emissions. Scope 1 emissions are the direct emissions that the companies put out. So, if you're a chemical plant, oil and gas company, but it's anything you're literally burning in-house. That's scope 1. You are doing the combustion. Scope 2 is indirect emissions. So if you're getting electricity from the grid, you're buying energy. That's emissions that's coming from the grid. That's scope 2. And scope 3 is the supply chain. It's everything else. It's how much energy your suppliers use. It's how much emissions your customers are going to, in the process of using your products, produce. It's commuting, it's business travel, everything else. So we take all that data, and we also take the financials of the company, and we basically start to do scenario modeling where we say, okay, what would be the global radiator forcing be if everyone in the world adopted the practices of a single company? So if everybody in the world was behaving like Exxon did, scaling up those practices, what would be the radiator forcing at a global level? And then put that through a model. So if everybody behaved like, Exxon, the world might be, I don't know, I'm just making the numbers up, but let's say 6, 7 degrees warmer. If everybody behaved like Apple, it might be 1 or 2 degrees warmer. And there's a whole spectrum. So this is a way to compare apples to apples, because a small domestic company with, let's say, 200 employees, if they have the same emissions as a giant multinational corporation with thousands of operations and sites everywhere, if they have the same emissions right now, a lot of the state of the art, just look at the emissions, and it's like, well, these two companies are the same, they're emitting the same amount, but that's not the same way of practicing, right? If that company became the size, if the first company became the size of the second company, they'd be a lot worse. So we want to actually scale up the practices and start to do scenario analysis for the individual corporations. So that's where a lot of the climate modeling comes in. And the way, more specifically, the way that's done, we started with a very simple approach, and to a large extent, that still works really well. So if you're considering all emissions, again, scope 1, 2, and 3, meaning the entire supply chain, very first order approximation could be, okay, if I just look at the revenue of the company, the revenue is basically taking everything that came before it to some extent implicitly into account, because if you're selling an iPhone, the total amount that phone goes for kind of includes the materials, includes everything else, it includes everything behind it. So why don't we compare that to the size of the global economy and scale up the practices of, let's say, Apple by that ratio and put it into our climate models? And if you don't have supply chain data, which in a lot of cases you are not going to have access to supply chain data, again, the data component is a whole other beast here where you just don't have data in a lot of cases. But you can compare let's say gross profit, so just the margin that the company is making after their costs from their suppliers are taken out, with the emissions that they directly are putting out, and comparing, basically using that ratio of the profits of the company in their own little value add compared to the emissions that they themselves put out, and then scale that up with the global economy and say, okay, if everyone behave like this company, and this could be made more and more sector specific, where every sector would have its own scaling as well. What would the global radiator forcing be? So once we do that, we basically built our own climate model in-house, and we do this scenario analysis until the end of the century with that specific radiator forcing. So each line is basically the hypothetical world of a specific company. This might be an oil and gas company. This might be, a very cleanly run company. That's better than the status quo. It's going to go on down. And this way, you can actually directly compare not just individual companies, but start to do portfolio level analysis of like, okay, I have a whole bunch of companies. Now I can put them all into the same rubric of global trajectories. And this isn't just temperature. I'll get to that, but multiple metrics of that hypothetical climate world, and just start to evaluate whole portfolios. And what's really nice is once you have a scenario analysis engine for the climate, you can actually start to put in all kinds of assumptions about the companies. So you say, you know what, right now, given this company, the way it's behaving, it's gonna, let's say, taking this example, this is a real company, but I forgot what company it is from a while ago. So the baseline, the way they were behaving in 2021, if they continued behaving like that, considering all their supply chains, it would go, let's say, to a 2-degree warming scenario. But what happens if they actually do stick to the targets that they themselves said they're going to do? You can model the climate, and you can see the pathway in that scenario. And more than that, you say, you know what, I don't think they're going to get to their target, but I'm going to do a Monte Carlo simulation on a portfolio of 500 companies and figure out all kinds of scenarios that this might play out. I could see that this company A is putting a lot of green infrastructure in, and company B isn't, and I think they're going to switch to renewables. So let me put that assumption in and see what would happen if they actually start to go greener, or maybe the company itself shrinks over time. Like, I want to see what happens if their financial shrink, and start to model all of that. It basically becomes a big computational engine for analyzing the climate impact of corporations. And it's a really powerful tool specifically for financial institutions where they have all these portfolios. As an investor, you might say, I want to invest in a portfolio that is aligned with the Paris Agreement, or it only has 1 meter of additional sea level rise, this portfolio that I want to invest in. Without doing things like this, how do you decide? But if you have a hypothetical world where you're extrapolating the behavior of the companies, then you could say, yeah, this portfolio is gonna hypothetically, if everyone behave like that, lead to a 2 meter sea level rise world. Now I'm gonna get to the sea level in a minute, but how do we know our pathways are actually correct? But I'm just gonna talk a little bit about some of the validation that we're doing. So there's 2 components to it: testing the physical models and testing the socioeconomic sort of scenario analysis that we do. So first, I'm going to start with the physical models. So just as a illustration, we took the forcings of the 4 RCP scenarios, and took the 30 or so CIMIP 5 models that are in AR5 and the IPCC, and looked at the range and the mean of the temperatures by the end of the century, specifically the mean from 2081 to 2100, that the average of the CIMIP 5 models produced, and the range. And then we look at the temperatures that our physical model is producing. And the physical model, the nice thing is it's a lot easier to test and validate than the socioeconomic part, which I'll get to. But it's very much within the range of the semi-5 model, so we can tell. We could also use semi-5 models and everything else too, but maybe in the Q&A I can comment on the climate model a little bit. But yeah, so the physical model is sound. It's within the range. It's working well. We've tested it in a lot more scenarios and well-established pathways, and there's no worry there. The more interesting part is how do we test the actual socioeconomic pathways, industry pathways. So the reason I say industry pathways is we evaluate individual corporations, but how do we, or nobody else is really doing that specifically. So what we could do is to take our bottom-up approach where we are evaluating individual companies and take some existing top-down estimates of the climate pathway of entire industries and see if they match. So the Climate Action Tracker is a organization that's putting out reports like this all the time, and they produced policy pathways and target pathways, meaning policy pathways meaning if they continue the industry, so we have aviation and international shipping, if they continue their current policies, what would the pathway of the world be? And if they change to their target practices, what would the pathway be? And independently, we took our own models for these two industries, and you could see the Envai policy and target pathways, and just saw if we have any agreements. This is just again 1 point of illustration. Now the Climate Action Tracker doesn't produce the entire time series to model the entire trajectory, but they have snapshots where they say by, let's say, 2030, the range of temperature is going to be less than 2 degrees, or more than 4 degrees. So we can at least compare that. And as you see, we actually get pretty good agreements. We've done more case studies as well. It's you could see in a lot of the cases, the error bars are so large for, let's say, the policy pathway from the Climate Action Tracker that it's gonna agree under a lot of different cases. But the more case studies we do for specific verticals, the more we can get confidence in the approach. But yeah, so far so good. It's always good when you're top down and the bottom up measures. I agree. So, and I should mention there's more and more. I'll mention some of the other frameworks that are popping up as well at the end, and there's more opportunities to do this kind of validation, and I think that'll move the industry forward as these socioeconomic climate models all start to hopefully fit into one another. So back to sea level. So great, we have this climate trajectory for individual corporations. Now, how do we measure the sea level contribution of an individual corporation? So again, we wanted to take initially a simple approach that works well across the scale. And I think this is where the people in this audience could also, be interested to hear people's feedback and thoughts on, additions to this. But we basically took a simple approach, and we take the transient sea level sensitivity from. So basically, the idea is the sea level by the end of the century, by 2100, is not just going to be determined, obviously, by the temperature at 2100, but it depends on the entire pathway. And so, as a first order approach, the century average temperature is a better measure than just the 2100 temperature. There was this paper that came out in 2021 by Grinstead et al. And they linearized the relationship, and directly quoting from the paper, relationship between the average rate of sea level rise and the temperature increase representing the preceding century. So is there a simpler approach we could take where we take the mean temperature of the pathway for the entire century, for the 21st century, and compare that to the expected sea level rise at the end of the century, and just work out a relationship that we could use as a simpler approach. So they did this. They took the time average, global mean, the temperature anomaly, and the sea level rise, the sea level rise rates measured by meters per century, and they looked at historical data. So there is pre-industrial, there's a tide gauge record from the 1900s to 1990. There's a satellite altimetry record going to 2017. And they took basically expert opinion. There's AR5, all these things that we're familiar with. And they basically put them all on this plot. And you can see the cumulative CO2 forcing on top as well. And you can see the linear relationship that would be very useful for us to use to say, okay, if we know the pathway of a company, now we're not in the realm of historical data or AR5 going to the end of the century, but the hypothetical worlds of all these companies. And if you can use the same relationship to evaluate the sea level rates for each company, that's the easiest approach. That's still valid, right? So that's the approach we took. So the numbers that this paper found, they used the 4 sets of data that was in the previous plot, the historical observations, expert elicitation, AR5, and the SRO-CC. And we were looking at the sea level sensitivity. So how many meters of sea level rise per century, per Kelvin, per degrees Kelvin, that's the average of the whole century. And you also see this balanced temperature. That's just the, basically, if I go back, that's basically just the balanced temperature is what they call the intercept here. This gives us a simple measure to convert the pathways to sea level and give some uncertainty bounds. And we took the expert elicitation, measures the 0.47, and the uncertainty, and basically plugged into our climate models. And again, I'm hoping to have a conversation with the group on people's thoughts on this. So what then that looks like is we have our corporate trajectory. So this is kind of what I saw before. This is a portfolio of, I think 20, 30 companies. I just put it together last night. And each company, very different ranges, going all the way up to potentially almost 10 degrees Celsius in very extreme cases of, like, if everybody was an oil and gas company, it's crazy world. And using these simple sensitivity rates, then we can actually come up with the sea level estimates, right? So each bar is one company in its own hypothetical world, going to like 3 meters, and then you have the uncertainties of more than 4 meters in some cases. A lot of the cases, sub-meter sea level rise by the end of the century. And the x-axis is just the number of stocks held in this one particular portfolio. It doesn't really matter. It's just, if you have a portfolio that's composed of different company stocks, then like this company almost has like 100 stocks of this company, very little of that company. It's just an example that was in the database. But yeah, now I can actually assign sea level rise rates to individual companies. Again, not that they're actually going to lead to this sea level rise, but if everybody behaved like them, this would be the hypothetical scenario of the world. So one interesting question to ask is, okay, from an investor point of view, if I'm trying to minimize my impact on sea level, but still trying to make money, is there any trade-off there? So if I decided to invest in companies that are having minimal impact on sea level, am I just gonna lose a lot of money because those are not money-making companies, or is it gonna be fine? So what I plotted here is the 1 year and on the left, these two columns, the 1-year return on the stocks, and on the right, the 5-year return. Just meaning, let's say if you bought like Apple, these are all public companies, I should mention. So if you buy like Apple stocks and you hold the stock for 5 years and then you sell it, how much are you gaining? How much has the value went up? So just a sense of, from an investor point of view, how are these companies doing with respect to their financials versus their C-level impact? And then plotting it versus the global mean C-level price. So given that we are calculating the C-level rise rates as meters per century, and this is basically going all the way from 2000 to 2100, it's just the total C-level rise that's happening in that century. And it's really interesting. So first thing, it's a log axis on the for the x-axis, a log scale, I should say, on the x-axis. So very different rates. But you'll immediately notice you have companies on both sides of the spectrum, and there's no clear reason to say companies with minimal climate impacts are not gonna gain you money. In fact, there's a lot of companies that have had very high growth rates that are at the very low side of sea-level rise impact. There's a lot of companies in the middle. So you'll notice that the 1-year return is sort of a lot more concentrated, and then the 5-year returns start to spread out as you're giving it more time, and the absolute values are higher because you have 5 years to get returns on. It goes up by an order of magnitude. But overall, there's a lot of companies in the middle. You can have a company that's giving you the same returns, but could be as low as 0.5 meters sea level rise or as high as more than 2 meters of sea level rise with the same financial outcome. So if you have tools like this, you can actually figure out, okay, how do I choose the company that's growing the same way, but it's having a less impact on sea level. But more importantly, I can choose companies that are here, right? Have very high return, very low sea level. There's this argument that people say, in the ESG space, well, if I didn't support any company that's not environmental, I just wouldn't make any money. It's like, well, not necessarily true. There's plenty of companies. And there's companies, if you look at the 1-year return, like there's companies that have way lower sea level impact than like this bunch over here, or even this bunch for including the supply chain, scope 1, 2, and 3, 2 meters of sea level rise and basically no returns, right? So it could go both ways. The important thing is, I'm not going to claim that there's a trend that one way or another there's a relationship between these two. I think we need a lot more data and analysis to figure that out. But the point is, it's a much more complicated landscape, and you need to have the insight to pick and choose. And it's absolutely possible to pick companies that satisfy both criteria. Now, if you invested in every company that's environmental versus every company that's, let's say every company below 1 meter and every company that's above 1 meter, and like compare the returns, that's, again, that there's a lot of subtlety that requires its own analysis, but at the very least, there's a landscape to navigate and satisfy both optimization metrics. A lot of the frameworks, so again, just zooming back in terms of giving more context, there's a lot of frameworks that like really care about the environmental component, but there's still single metric mandates, the metric being financial returns. But increasingly, we're seeing the rise of dual metric frameworks where you have to increase financial returns and minimize climate impact. And so, if you can directly look at a graph like this, you see the sea level rise of a component of a company and its financial return. Then you can actually start to even think about doing a sort of two metric optimization problem. So it's an interesting time we are in. It's an interesting point in time where it's encouraging to see kind of these movements. And then just to bring it to a close, I'm just going to talk a little bit about there are other frameworks that also try to tackle some of this. There is not a lot going on in terms of sea level in other frameworks. Um, as far as I could find still, there's no one else that's providing direct company impact scores or metrics of any kind for sea level. But there are companies that are trying more and more to come up with trajectories for temperature, and you can always, once you have a trajectory, then get everything else from it as well. But the one company that can't not mention, because they have such a big share of the industry world, is MSCI is also putting out a temperature-based metric where they're taking a very different approach, where this is just to highlight how different the approaches are. So they actually start from the global allotted carbon budget that's put out, let's say, by the IPCC. Like if we need to stick with a 2-degree warming scenario, we can only put out this much more carbon. And then based on the size and the industry and the activities of the company, number of employees, they say, okay, if the global budget for the remaining carbon is X amount, then this one company has this amount that's allocated to it. So they take the global carbon budget, remaining carbon budget, and they break that into specific company carbon budgets. So maybe as a company, you can only put out like 1,000 tons of carbon at most before you reach your allotted measure for the world as a whole to be within 2 degrees warming. And then they just calculate overshoot, undershoot of the targets from the allotted estimate. So if you have to stay within 1,000, let's say, tons, and you emit 1,200 tons, then they take that overshoot of 20%, and they basically there is no climate models that run this scenario, but they basically just have a scaling factor of 0.0005 degrees for each gigaton of carbon globally that's put out. So they basically take the overshoot, undershoot of the company, scale it back up to the global undershoot, overshoot based on the global budget, and they scale it globally by how much additional temperature would rise. And so they basically have this additional temperature, implied temperature, with respect to a 2-degree warming world. Very different approach than what we're doing. Saying all this just to highlight that there's still a lot of different frameworks and ways of thinking about this that are out there. It's a very rapidly moving field. There's also other approaches. People are doing all kinds of stuff. And to this day, most financial institutions, most banks, most companies don't even know where to start. So there's a lot of bottom line frameworks like the GHG protocol, PCAF, other frameworks that sort of provide a underlying way of thinking about these things. So a lot of I mentioned like scope 1 to 3 emissions, all that kind of stuff, that comes from the GHG protocol. So the standards are starting to kind of come together, but there's so many layers that are being built on top of it that are just super hand wavy still, maybe. And there needs to be a lot more consolidation. And I think that's where we need input from the scientific community, right? So the scientific community, I think, has, for good reason, focused a lot in terms of outreach and applicability on the climate risk aspect. Like sea level rise for each city, how it's going to impact infrastructure. And again, that's probably the most important thing anyways. But there is this whole other world of mandates that needs a lot of robust science to actually figure out not the impact of climate on companies, but the impact of companies on the climate. And this includes many metrics, including sea level rise, temperature, biodiversity, other metrics. And hopefully we can get to a framework where, just like for accounting standards, there are standards that everybody can adopt and sort of apply across companies and sectors, even countries, getting to a point where there's a robust scientific framework for applying climate mandate practices across, all the different sectors. So with that, I'll just wrap it up and see if there's any questions. Hopefully it was a bit of a different talk that provided a perspective on how this science is used all over the place, and what there's so many new climate rules being opened up at all kinds of big like financial institutions, big banks, and most of it these days it has to do with mandates. So I think it's good for the community to be aware of a lot of that. And yeah, happy to hear any comments, questions.
Okay, thanks a lot. Yeah.
Yeah, absolutely.
Good to have your perspective. Yes, Jeff has a question.
Yep.
Oh, hi. The idea of overshoot is quite commonly used in climate modelling, and that you've got to go to negative emissions if you want to come back, and the corporation can't do negative emissions in and of itself. It can do offsetting, I suppose, but how would you deal with that?
Yeah, so we do, when we take the total emissions, that's a really good question. When we take the total emissions of a company, they actually, some companies have a sequestration budget in their emissions that they put out. And we do basically take that. So from the total emissions of the company, we subtract the sequestration they have. Now, there's a lot of funny business going on, as I'm sure you can imagine, where first of all, not every sequestration is the same, and there's a lot of stuff going on there. But when putting that aside, a lot of companies basically group avoided emissions as sequestrated emissions. It's like we didn't fly this much, so we saved this much carbon. It's like just because you didn't emit it didn't mean you took it back, right? So there's like a lot of weird stuff going on, and they say, oh, net, like we're basically zero, but we try to be really careful with that. So only the sequestration, that's one way or another, if they like paid some company to go plant trees, again, it's not the same. If you're like pumping oil out of the ground and just planting a tree that's going to decay in 100 years anyways, but at least they're doing something. So we take those into account, but we don't take some other aspects of like hand wavy, like avoidance of emissions into account. It's a there's no clear answer there, but we try to be objective when we deal with companies.
Right, thanks.
Yeah, no worries. Yeah, I think we have a question from Shana.
Hey, thank you so much. This was a really great talk. I have actually kind of a few questions just to contextualize this real quick. I was also an ice sheet modeler, and now I'm working at Union of Concerned Scientists doing corporate attribution work and looking at sea level rise. And UCS has an internal model where we're usually doing modeling historical trajectories to do attribution work in the past, and then I'm thinking about extending that to the future. So I'm super interested in hearing a little bit more about the model that you've developed. I know you said like ask about that during questions, so I would love to hear more about that. And then I haven't read the Grinstead paper yet, but I'm wondering in that TSLS relationship, is there how are like nonlinear ice sheet dynamics accounted in that? So that's my second question. And then I'm so sorry, but I have more questions. My third question is, has the political pushback against ESG and the forthcoming SEC rule, has that impacted your work at all? So thank you so much.
Yeah, yeah, that's great to hear that the work you're doing. And so let's try to answer those one at a time. In terms of the climate model, yeah, so we wanted to take a lightweight climate model where we can just run it quickly. So every time we get a request through the API for a specific scenario, we have to run the whole climate model for that hypothetical world and return it as quickly as possible. So we wanted the model to be really lightweight. So we started with basically open source, public, like Pythonic climate models, and just try to work, like build on top of them. So there's things like the FAIR model, like in Python. I don't know if you're familiar. Yeah, and then we started from there and started building on top of it. I have to be a little careful about like the stuff that we built on top in terms of just corporate competitive, our additions. But yeah, we to answer indirectly, but as much as I can, we started from the open source Pythonic frameworks like Fair, and then built on top. To answer your second question, yeah, that paper actually talks about they attribute different scalings for the thermal expansion and like glacier melts, and they do say even though we don't expect the glacier melt to be, it's not a stationary process, the scaling factor as a whole, it's a good enough approximation, and in that plot they had basically pre-industrial going all the way to the end of the century under like RCP 8.5, and the total scaling was basically let me see if I can pull up the cover here. There's some interesting plots there. But yeah, they basically said there's no reason to not think it's not a good enough measure for it to be stationary as a whole when you take full components into account by the end of the century. So yeah, we figured, but I am interested actually. I do kind of want to turn this around as a question to everyone too, that like if there is a better way to do that one component, and like what people's thoughts are there. So it's as much a question for everyone as for me. Yeah, I don't know if Jeff, do you have comments on that, or is it a different question? Feel free to comment if it's on that.
That issue of the climate model you can use, and these idealized climate models are the way to go. I mean, there's no point in doing a full climate model. So they're just emission-based models essentially, but you've got to be quite careful when you're using something straight from the net, that because what we do with them is we calibrate them to a climate model, a proper climate model. And they scale quite well, except for when you've got non-linear processes, such as deforestation things.
Yeah.
But for all intents and purposes, you could still get, using those methods, you can get too high temperatures by far, because you haven't got the carbon feedbacks and things. So what we do is we just scale them to real models, but you can't do that yourself, but other people could.
Yeah. At some point we have to think about the trade-off of what we're getting in terms of as a company. But yeah, absolutely. I think it becomes trickier and trickier as you go higher end, and that's one of the reasons we even wanted to have a climate model in the first place, because what a lot of other companies do is to just take the emissions and just multiply them by some factor to get the temperature right, and it starts to get really wonky as you go on towards the higher emissions, because it's not linear. So at least having a climate model with like actual carbon reservoirs and the components would be a little bit better, but I do agree for sure. And to comment on let me share my screen for a second. Yeah, so this is the paper that I referenced. So they do break down the components, right? So the steric and the ice component, and the specific thing that I was saying. So even though right now the dynamics is a smaller component and it's going to change, they're just saying it's good enough to be a stationary metric for now, and especially given the scenarios that we have for just within 1 century. I'm happy to send this paper after. But again, if there's a better way to, even once you have the climate models, to if it's a simple enough climate model that just gives you the temperature and you want to convert the temperature to a sea level metric, if there are other ways that, any thoughts on that, just going from the temperature to the sea level? I'm really curious to hear that component as well. Alternatives to this transient sensitivity that I mentioned. Yeah, I don't know, maybe happy to hear in general, but
I can just respond with like what the UCS internal model that they developed was relying on the Bob Kopp semi-empirical modeling paper from 2016, but it really mostly is valid for the historical case, and we haven't felt super confident applying it to the future. So I'm interested in reading this paper and thinking more about other options for this.
Yeah, happy to hear your thoughts, and we can stay in touch. And yeah, interesting to see what experts think. And then to answer your last question, which was about the pushback recently. So overall it's been really interesting because like there's been so many ups and downs with the whole mandate space. Like if you remember, I think like a month or so ago, there was the whole thing with including climate mandates in retirement funds, that like it was an executive order, and then they like banned it, and then it was vetoed. And like I think it's fair to say that there was a lot more hype in the field in like 2022 than right now, and some of the big players are sort of pulling back a little bit, but the underlying currents hasn't gone away. And we talked with a lot of financial institutions, and like banks in Canada, and they haven't changed at all. They're still going strong, and like they're working with internal teams, outside teams, consulting firms, all kinds of stuff to basically start assigning climate impact metrics to every aspect of their business, to the loans they give out, to the portfolios, investments. So it's really good to see that's happening. It's because I think everybody realizes that despite the short-term pushes and pulls, eventually it's going to come down the pipe. And like Canada, where we're based, there's like talk of legislation all the time that could potentially affect them. So they want to think long-term enough that they don't really, budge too much. Now, some of the data providers, or I should say like insight providers, you see the changes in them, because as the market pulls back, you're like, okay, maybe we're not going to like invest too much money in like providing climate impacts. And they like go back and forth. I won't name any names, but but the ultimate like buyers of the service, like the financial institutions, they haven't budged. They're still moving forward. And honestly, I think I became a lot more hopeful about all this, about the climate issue, when I transitioned to the private sector. Because from the outside, you think nobody cares, like whatever, they're just doing their own thing. There's a lot of momentum, and like it takes a while to see, but there's a lot of internal momentum, internal pushes. And like despite everything that's going on, like I don't know if the news was like big enough to be shared outside of industry circles, but I think it was last year, there was basically like some activist board members in Shell, or one of these giant oil and gas companies. Yeah, exactly. And like when it gets to that scale of activity, the companies have no choice but to embrace this. So then, if there's a little bit of a local push and pull in legislation or whatever, they don't care. They know it's coming down the pipe anyways. So I'm optimistic for sure. It's only going to increase. Yeah, Jeff.
Yeah, just a quick one before we have to end. But the companies like Exxon argue that it isn't their emissions; it's the public emissions by buying their product, and so the company isn't liable for them. So what you have to do is to convince the company not to drive cars.
Yeah, I mean, that's the whole idea of scope 3, and that's why there's so much pushback, especially from oil and gas companies, because a big component of scope 3 emissions is it's like end of life treatment of the products, the usage of the products, and a lot of oil and gas companies don't even include scope 3 emissions. And one of the big issues, so one thing that we're working more as a company is to just go to the raw data side and just figure out all these emissions, because they don't report it. And yeah, it's a whole thing. It's the good news is they're kind of, the industry is pushing them more. There are oil and gas companies that do include scope 3, and those numbers are ginormous, right? When you look at the scope 3 emissions, it's so much bigger than anything else you've seen. But not every oil and gas company does it. But if they do include it, then that includes the important component that you were saying. It's everything down the line from that. Yeah. It's a whole field. There's even the methodology of it is so the greenhouse gas protocol has like methodologies on calculating scope 3 emissions, but yeah, we get so many companies approaching us just to like figure out their own emissions. It's like, okay, well, that's a whole other line of business. You know, there's plenty of consulting businesses, but it's a very fast moving field, and a lot of companies legitimately don't know how to do it, and a lot of them don't want to do it for obvious reasons. But I think sooner or later they'll all have to.
Okay. Any other questions or comments? At the hour now. Okay, well, thanks again, Yara.
Absolutely.